Long-term U.S. Treasury yields are up sharply from April lows as policy shifts like the budget bill draw attention to U.S. debt sustainability. We view this as a return to past norms, as investors again demand more compensation for holding Treasuries. We see two reasons why. During the pandemic, investors accepted abnormally low risk premia for Treasuries as ultra-low interest rates offered a sense of safety about ballooning government debt. That pulled down global yields too. But long-term yields have risen sharply since April as investors reassess what is a fair premium for the underlying risks. In 2021, we flagged that inflation could spur higher policy rates, making debt repayments more expensive and deterring investors from long-term bonds. That's now occurring. In March, we estimated the US deficit to GDP ratio would land in the 5 to 7% range. We think policy developments since then could push near-term borrowing to the upper end of that range or past it. Yet we see an economic rule that limits how far policy can veer from the status quo. Keeping US debt sustainable relies on steady funding by foreign investors. Yields in the euro area have been rising as geopolitical fragmentation causes governments to boost defense and infrastructure spend. We prefer euro area government bonds to the US. We also prefer European credit, both investment grade and high yield, to the US on cheaper valuations. US Treasury yields have risen since April. That's a global story of normalizing term premium. We stay underweight long-term developed market bonds, preferring shorter-term bonds and euro area credit.